This might sound bold, but after everything you're about to hear, you'll understand exactly why this one stock is extremely undervalued right now, and why smart money is quietly paying attention while most investors completely ignore it. Welcome back to the channel Stock Predictor, where we break down real opportunities, real numbers, and real strategies so you can make better investing decisions with confidence. If you've ever felt like you missed out on Apple in 2009, Amazon in 2012, or Nvidia before the AI explosion, this video could completely shift how you see the market today. Right now the stock market is full of noise, trendy tickers, hype stocks, and social media-driven investing. Everyone is chasing the same names, the same magnified winners, paying premium prices for future growth that is already priced in. But hidden behind all that excitement is a company that continues to generate massive cash flow, dominates its industry, rewards shareholders, and trades at valuations that simply don't match its fundamentals. And that stock is Alphabet, ticker symbol Google. Most people hear Alphabet and think, Google is already huge, how could it be undervalued? That's exactly why the opportunity exists. When a company becomes boring in the eyes of retail investors, when it's no longer trending on social media, Wall Street often misprices it, and smart investors quietly accumulate shares. Let's talk about the business first, because valuation means nothing if the business itself is weak. Alphabet owns Google Search, YouTube, Android, Google Cloud, Gmail, Google Maps, and some of the most widely used digital tools on the planet. Google Search alone processes billions of queries every single day. It's still the default gateway to the internet for most of the world. That dominance hasn't disappeared, despite all the AI headlines you might hear. YouTube is another monster that many investors underestimate. It's not just a video platform, it's one of the largest advertising ecosystems ever created. YouTube Shorts is growing rapidly, ad pricing is improving, and creator monetization continues to scale globally. YouTube alone could arguably be valued as a standalone company at hundreds of billions, yet it's embedded inside Alphabet's stock price almost as a bonus. Now let's talk about Google Cloud, because this is where the market is most wrong. For years, investors complained that Google Cloud was losing money and lagging behind Amazon AWS and Microsoft Azure. That narrative is now outdated. Google Cloud has reached profitability and continues to grow revenue at strong double-digit rates. Cloud computing isn't going anywhere, and as AI workloads increase, cloud demand increases with it. Alphabet is directly positioned to benefit. Speaking of AI, this is where fear has completely distorted perception. Many investors believe AI somehow threatens Google Search. In reality, Alphabet is one of the biggest AI leaders in the world. They developed core technologies like TensorFlow, built some of the most advanced AI models, and integrated AI directly into search, ads, cloud, and productivity tools. They're not being disrupted, they're adapting. Now let's shift to the numbers, because this is where the undervaluation becomes impossible to ignore. Alphabet trades at a price-to-earnings ratio that is significantly lower than most mega-cap technology peers. While companies with slower growth and weaker balance sheets command higher multiples, Alphabet trades at what looks like a value stock valuation while delivering growth stock fundamentals. Alphabet generates tens of billions of dollars in free cash flow every year. This is real cash after expenses, growth investments, and capital spending. That money gives Alphabet enormous flexibility. They can invest in new technologies, acquire competitors, buy back shares, and still maintain a fortress balance sheet. And that brings us to shareholder returns. Alphabet has aggressively increased share buybacks. Every time they buy back shares, your ownership percentage increases without you doing anything. Fewer shares outstanding means earnings per share grow even faster over time. This is one of the quiet wealth-building mechanisms that long-term investors benefit from the most. Another point that rarely gets enough attention is Alphabet's balance sheet. They have massive cash reserves and very manageable debt. In a world where higher interest rates punish heavily leveraged companies, Alphabet stands in a position of strength. They don't need cheap money to survive or grow. They're self-funded, resilient, and adaptable. So why is the market undervaluing this stock? There are a few key reasons. First, regulation fears. Investors worry about antitrust actions and government oversight. While these risks exist, they are not new, and they haven't destroyed Alphabet's business model. Regulatory pressure has been present for years, yet Alphabet continues to grow revenue, profits, and cash flow. Second, investors are obsessed with the next big thing. Speculative AI stocks, unprofitable startups, and high multiple tech names attract attention because they promise explosive growth. Alphabet offers something less flashy but far more reliable: consistent cash generation, global dominance, and long-term scalability. Third, Alphabet doesn't pay a traditional dividend that income investors chase aggressively. Instead, they reinvest heavily and buy back shares. Many long-term investors actually prefer this approach because it's tax-efficient and compounds ownership over time. Let's talk about growth, because undervalued doesn't mean stagnant. Alphabet continues to grow revenue across multiple segments. Digital advertising is still expanding globally. More businesses move online every year. More consumers spend time on digital platforms. Google sits at the center of that ecosystem. Cloud growth remains strong. AI integration is accelerating adoption. Enterprise customers are locking into long-term contracts. This isn't short-term hype, it's infrastructure growth that happens over decades. YouTube continues to monetize better. Subscription services like YouTube Premium, YouTube TV, and music subscriptions provide recurring revenue streams. This diversifies income beyond ad cycles and makes the business more stable. Now imagine where Alphabet could be 5 or 10 years from now. Search enhanced by AI, cloud scaled globally, autonomous technologies like Waymo advancing, healthcare AI, productivity tools, and entirely new platforms under the Alphabet umbrella. You're not buying a single product company, you're buying an innovation ecosystem. From a long-term investor's perspective, this is exactly the type of stock you want to own when the market is distracted. Strong business, strong cash flow, reasonable valuation, and long-term tailwinds. This doesn't mean the stock will explode overnight. True undervaluation plays don't usually do that. Instead, they quietly compound, delivering returns through earnings growth, buybacks, and gradual multiple expansion as the market eventually recognizes reality. If sentiment shifts even slightly, Alphabet's valuation could re-rate higher, and that alone could drive meaningful upside without any dramatic changes in the business itself. Now here's the most important part. Investing isn't about excitement, it's about probabilities. And the probability that Alphabet continues to exist, adapt, and grow over the next decade is far higher than most companies on the market today. When you can buy that probability at a discounted price, that's where real opportunity lives. This is why long-term investors, institutions, and patient capital continue to accumulate shares when prices are ignored. They understand that valuation gaps eventually close. Of course, no stock is risk-free. Ad revenue can fluctuate, regulation could impact operations, competition remains intense. But these risks are already well-known, widely discussed, and more than priced into the stock today. The market is offering you a chance to buy one of the strongest businesses in the world at a price that doesn't reflect its true power. Opportunities like this don't appear often in mega-cap stocks. And that's why, in my view, this one stock is extremely undervalued. If you found value in this breakdown, make sure you like, subscribe, and stay connected with Stock Predictor, because this channel is all about finding long-term wealth opportunities before the crowd does. Let me know in the comments what stock you believe is undervalued right now, and if you want a deep breakdown on another company, drop the name below.